Dear Mr. Wohlfall, Mr. Leber, ladies and gentlemen, I'm really happy to be here with you today. And well, actually, you can hear me a lot. That's so I'm a rather public figure, well, economic and financial politics in the turn of the times, big insecurities right now, Germany in recession, as we say. I would like to sort things in a little and make my comments to economic and financial politics. I would like to, or I always try and take current events and then talk about the long term and to say what we're facing. And I just heard that the bar is really high, and I try and pass below it. So you will need to ask questions afterwards and challenge me. So in January, we had a discussion with Mr. Leber and myself that we presented as a virtual talk where he really challenged me. And right now, I'm still pretty comfortable. So let's see whether you can make me uncomfortable. So when it comes to the current situation, if you have a look at that, what does recession mean? So just currently the German Federal Bank have given out their view on the current economic situation. Is that only a technical recession? Yes, this is currently only a technical recession right now. And in order to cater for the demand of the media who just want to calculate 2 quarters with a lower GDP, then that is a recession. I don't know who invented that, but the elite, the National Bureau of Economic Research and the like, they and also the expert committee for Germany, they use many indicators, and if we have a look at that right now, then it is way too early to say that we are in a recession right now. So 2 quarters with negative growth rates are not enough. And so if we take a look at the situation, then we can say that, okay, this is not enough, but the situation isn't great either. So what we see here are the forecasts for Germany, always revised. So dark blue is for the current year, and light blue for the upcoming one. And this doesn't really look great. These are only the forecasts of the main or the public institutes. So I left out the Deutsche Bank, who is at -3, so follows the IWF. But what is decisive about that is that never mind whether we are at -0.2 or +0.3 for the upcoming year, for the current year, you have we are diagnosing a stagnation. So this is the environment in which we're moving. And this is the environment that I already forecast last year. So getting into a stagflation, so weak growth and high inflation. This is what we can see here. So looking back, this is better than everything that the representatives of the energy sector forecast last year. They really forecast bad times, but well, that didn't happen. Well, the chemical industry and the other raw material or industries in Germany, those forecasts were exaggerated. So history was a little bit too much. But looking back, this is the only positive thing about the current situation. So looking into the future, we're currently not seeing where the dynamic should come from for the German industry. So when it comes to innovations, so burdens are big, and we're just in front of, we're just facing the transition into the demographic change, and we always need to ask ourselves, where will people come from? And then the demographic perspective already tells us why people are going into other corners of the world. And this also is valid for the expected energy costs. And if we have a closer look at that, we need to really, we will face higher energy costs in the future. And also this is not a good perspective for investors. And this is what we're facing. So I don't know who of you, who wrote the speech for Mr. Scholz, where he talked about a new, where he talked about a big growth of economy. I would say, please exchange this person who wrote that speech, because, well, the growth of 1950 to 1960 was at 8.2% in average. And as you can see from the current weak development and looking at the demographic change, how we are supposed to get to 8%, this is the secret of Federal Chancellor. This is not going to happen. So you must say that the background for this was that we are going to exchange the existing capital stock against another climate neutral capital stock, but this is only the exchange from an old one to a new one. There's no dynamics here, no growth. This only comes when there are innovations linked to that, and not one is being replaced by another. And this is what we need in order to have dynamics. And innovation is strongly linked to costs. And well, if costs are high, then investors are taking this up the back. The second thing is the burden of economy is also coming by inflation. Inflation is battled with high interest rates, and these have direct impacts. And so also for the first time in the last 2 months, the core inflation has gone down. So this is not shown here. You only see the headline inflation. So in blue, European inflation rates, and in orange. And in orange, these are the German ones. So we have the consumer price index that is calculated in here, and then below we have the European development without energy prices that has gone down twice in a row for 2 months right now, but it's still high enough. And we just celebrated the anniversary of the ECB, and in those 25 years, well, they did a pretty good job. Inflation was at round about, was between 0 to 2%, so within the framework of price stability. And since 2021, this is different. So 21, 22. This is that they don't do good politics anymore, because inflation has risen a lot. And why do I attribute that also to ECB? Because in the end, this is due to the expansive collaboration between financial policy and the COVID-19 pandemic. And what was the situation? Well, the ECB, as with other central banks, especially the Fed, they really had a loose financial politics, that they purchased bonds, and with that they refinanced the debts of the European states. And this refinancing means that additional state debt was taken up there in order to cater for higher expenses, and this was higher state transfers and higher investments into the economy, and so they had an impact on prices. And without the broad monetary framework of the ECB, this wouldn't have been possible. So from 2020 on, the mechanism was different than the one that we saw the previous 10 years before via the bank system, when the additional liquidity could be used in order to clean the bank balances and to get rid of bad debts. Well, this is the situation that we have right now. And this is what has to happen, and what is happening: a more restrictive monetary policy by raising interest rates, and also by accelerating the decrease of the bonds in the balance of the ECB, or in the system of the European central banks. And so, well, this is more a German view. You see so I always like to use the refinancing index, and you see here the 10 years government bonds, and a little something for the real estate market, because I'm going to talk about that. In order to make clear the mechanism, we have a close collaboration between monetary and finance politics. And to the left, you see the bond purchasing program. We have the PSPP in blue, and in orange, the program by Lagarde, the PEP. And this will end in summer. So the next 3 months with 0% bond purchase, we have a little reduction. We included that, but after that, this will only be at 0. And right now, the stock is reduced, and I don't have the figures for April yet, but we're going to see how this is going to go on in the upcoming year. So at the end of last year, in the stocks, in the inventory of the central banks, we see that there were governmental bonds, and in the case of the Netherlands, we're already at 50% or almost 50% here. Of outstanding bonds, so we have more than 1/3. And ECB from 2015 on, but at the latest of 2020, they were market makers for bonds. And now the question should be allowed. So if they get out of bonds, what will happen then for certain member states? We're going to get to that soon.
Ja, ich mache doch eine freche Bemerkung zur Inflationsentwicklung.
Well, I'm going to make a comment on the development of inflation. How is it going to look?
Ich höre die Jubelgesänge in den Medien, dass
well, I already hear the media singing that we're going down from 7 to 6% compared to the previous month. I know this is, but that still means that we have price increases of over 6%. This is nothing encouraging. This is far away from the target, but the target value has no normative value. This in order to have price stability. So for 6%, at 6%, we don't have price stability. And so for the central banks need to do something, even if it's going down. Even if we are going into the direction of 2%, then the central banks will be able to do less. And so the expectations of increases of the interest rates by 25 basis points, well, this is pretty probable, actually. And we see that inflation is staying with us. The core inflation is sinking slower than headline inflation, and we have special effects. So in the end of the year, we will see what really happens. So currently, I expect that after this raise of further 50 base points, the ECB will wait. In the summer break, they will do nothing anyway, because everybody is on holidays. But then, in order to see how this monetary policy will work out and whether the inflation will be reduced more than. And in conjunction with this, we will see whether the ECB will need to increase the interest rates again, and how long they will leave the interest rates at that level, or whether they will reduce the interest rates. I don't see that right now due to the development of the current inflation. And so why do I say this here at the forecasts? And here we see that the inflation rate for the upcoming year might be below 3%. And that means here we will really need to have a low inflation this year, so that we can see that for the upcoming year. The ECB is is more cautious here. They have a 3 in front of the comma, and in front of the point. And so also the raises for salaries, they need to be taken into account. So the salaries, the effective salaries should rise by 6% this year, and so it is unclear how far this can be offset. So the phenomenon of inflation will stick around for a while. So, and what does that mean for the economic politics? So I'm first we get to the increases of the interest rates and their impacts. So when it comes to real estate, I've already addressed those. These react very sensitively on increases. Well, they are really they're on the ground, and we saw that in the past year. So approvals have gone down, construction is slowing down, and the first month of these years, we have cancellations of more than 10%. So we have big corrections on the real estate market, and we see that in prices in part. So already, if we look at the orange curve here, you see how prices on average in Germany are going down. And so the real estate market is always a special market and depends also on different regions, cities, and situations. But nevertheless, you see corrections in Munich and in Frankfurt that are much higher than they were expected. This is the situation on the real estate market. It is a difficult, has been a difficult year for real estate. This is not only the third quarter, but it is also the fourth quarter. But when it comes to economic real estate, this has happened way earlier. So in 2018, we saw that, but yeah, prices are going down, and the big raises from the previous years, they can't be realized anymore.
Der zweite Sektor, der davon betroffen ist der Bankensektor. Da habe ich extra keine Grafiken mitgebracht, damit Sie mich nicht explizit zitieren können. Die Auswirkungen der Zinserhöhung auf den Bankensektor haben wir in der jüngsten Zeit insbesondere in den USA gesehen.
The effects could be seen mainly in the US. In Credit Suisse, this has been well different. Also in a situation where the entire environment changes, we have well, these kind of situations get more in the focus than they were before. And I wouldn't see the Credit Suisse as a special example for the impact of interest rates onto the banking system.
Das Problem wird nur sein, in welchem Umfang diese Einzelfälle sich so summieren, dass man jedes Mal ein ähnliches Muster erkennt. Also bei der Silicon Valley Bank ist die Situation durchaus anders als bei First Republic.
So at the Silicon Valley Bank, it is different than in First Republic, but have the medium-sized banks and the smaller banks that we have that we might have more problems here, and well, that there might medium-sized banks that are currently there should not be spillovers. But it is that way that bigger banks in the US should now be able to buy the medium-sized banks. So we have a concentration on the American banking sector. That does not mean that we will have spillover effects to other countries.
Now, what is it like in Europe? In accordance with the numbers that we have now, the situation in the European banks is rather robust. Europe, compared to the United States, has not taken the mid-sized banks out of the close regulation of Basel III, but left them in, and that was the right step. So not to give in to all the lobbying that came from the banking sector. They actually stood their ground. And together with what I just said, en passant, which is the kind of recovery of the European banks due to the situation that we had in 2008 and 2009. We are more robust now. Now, question is that based on the more difficult situation in the real estate sector, we will see more effects on the banking system. What kind of depreciations and write-offs will become necessary? We cannot see that now. This is something we will only see when we see how problematic the real estate sector really is. This is true in particular for Germany, but we see this situation also in other countries. And then we have a number of banks that are more dependent on the transformation of deadlines in their core business. I don't have to explain that here, of course, but there is a number of small banks who is much more dependent on that core business. And in our banking system, this is an ongoing consolidation process, which will be accelerated by that. On the other hand, view of the increased interest rates, we see better possibilities for business for the banks because they pass on the higher interest rates. They don't pass on the higher interest rates to the saving deposits, but they increase their interest rates in the loan business, so the margins are increasing, and I think this will be another recovery effect that we can see here. So we have to see what this means in the end, but this is just a rough framework that we're in right at the moment. Regarding the databases, I don't see much of a concern that the European banking system right at the moment would run into larger problems. This does not mean that this would be excluded. That brings me to the third point, and that is the financial policy. That's also something we have to look at. This is a sector which is also affected by the higher interest rate. To what extent? Well, the group on the left side here is more affected. That's the high debt countries in the EU. They have more than 90% or more than 100% government debt ratio with regard to the GDP. That 2022 was now on the level of 2016. This is to do with inflation. If you look at the debt situation, here is the gross debt rate that is increasing more because of the deficit that we have, maybe a bit less, depending on the income system and how much it is affected positively by inflation, where you actually try to level out the progression. That's a different thing. So that's dampened there. But in the denominator of the rate, you see a muscle which is increased if you look at it from point of view of the GDP deflator. So the debt rate may also decrease. That's always a short-term thing because the government also has to pay more in case of inflation, because on the expenditure side they have to spend more money for higher prices. And when you have the progression on the structural side, on the income side, you don't have many good effects for the government budget. And when you look at the new tax estimates, the value-added tax doesn't have much dynamics because the consumers are changing their consumption. They buy cheaper goods. And this is, again, because of the difficulty of the economic situation, because there's a decrease in private consumption. So those are the governments with high debts: Greece, Italy, Portugal, Belgium, France, Cyprus, Spain. And actually, the good phase of the better economic development after the debt crisis in the EU, they could not make use of that as well as the ones in the middle who were able to decrease their debt ratio. Now, what's happening? This is a simulation for Italy and Spain. What is happening in the government budgets when interests are going up? And this is actually a calculation from 2022 on. Sorry, no, 2023 on. That's the simulation. So that's the middle that you see here. That is the forecast time. You got the interest rate expenditure of the government in percentage of the GDP. So what has to be paid from the economic power? The overall government, central level, regional level, communal level. Now, if we look at it for Italy, the blue curve was pointing downwards. And when we if we stayed in the low interest rate from August 2021, it would have been consolidating itself with much lower interest rate expenditure. But if you look at this interest rate structure curve or yield curve in orange changed from beginning of this year. The interest rates are increasing, but with the amount that we had at the beginning of this year, Italy could still be not worried, because only the 30s onwards, they would go back on a level of interest rate expenditure that they had in the height of the debt crisis in 2012. So it takes a while till when the bonds and the indebtedness that they have now are affected by the higher interest rate, and this would lead to a higher burden. This is just illustrating the situation. At the beginning of 2012, the Italian government had to pay an interest rate, or had to offer an interest rate of more than 7%, so that investors were buying on the markets. In the past year, they refinanced the 10 years bonds at an interest rate of 4%, so they actually were able to save some of the interest rate. And if we look at the whole yield of the whole tenor, it looks a bit different, but you see this here. But what you see here in the red and the green curve, I see it here in green at least. So when you can look at that, the higher the interest rate gets, the more this period of grace that Italy still have to consolidate and convince the markets that they manage to get their debt ratio under control is shrinking. And I think under this background, the significant resistance of the Federal Minister of Economy must be understood regarding the fiscal rules of the EU, because that would enable the countries, the member countries, to have a higher debt ratio. And this is, for instance, due to France. They want to have more expenditure for defense and for loans, and they don't want this be put into the fiscal rules. So they want more debts and less debts. Not less debts, but we need less debts. That is what is actually needed. I can only say I'm quite happy that I don't have to be part of that negotiation in Brussels. I think the Federal Minister of Finance in these discussions is really very patient. I would not be able to show that patience, really. Germany's situation is not that brave. This shows us our consolidation since 2020, about 20 percentage points. We decreased the indebtedness of the government from more than 80 to about 60, about 1/4 of reduction of the state indebtedness. That is a significant consolidation. It was astonishingly easy because we had a lot of income and interest rates didn't have to be paid. 300 billion euros the German government could save because of the low interest rates. No, but now at the situation of those who are on the other side, it still looks good. And that might be interesting to you because we've got these individual funds that we still have up, but the overall debt to GDP ratio is pointing downwards. From 2020 onwards, it went down towards 60% step by step. And if we look at the structural fiscal balance, you can see that the debt finances are now going towards a kind of balanced budget. How can that be? Here you have to see the realized figures. In the forecast, what can be expected, what of the money that we have is really implemented. There's this special fund of 100 million euros for the army, but in the past year we didn't spend 1 cent because we cannot order what we need. In the Netherlands, they ordered a lot of ammunition from Germany, 2 to 3 million euros. I think that's not a little amount compared to us. It's a smaller country in the Netherlands. And we know that the federal army, compared to regarding ammunition, doesn't have much at their availability. They couldn't last longer than 1 day in case of invasion, and we were not able to order this. So till those 100 billion will be spent, it takes a long time. It's actually distributed over long years. And the same is the integration fund. It's got 100 billion too, but it's increasing depending on the income of the CO2 prices. So of the amount which was to be used for 2022, not even half of that was used. And a good part of that, good share of that, was the takeover of the energy allocations to the Federation. That was an easy move, but to trigger investment is not so easy. And it's the same with the Economic Stabilization Fund, which has been renewed again last year because of the gas and power price limits. The calculations of all the forecasts that I've seen up to now assume that we will not even have to use half of that volume unless there would be a further change of law when it comes to the heatings or the industrial power prices, on the other hand. So and then we talk about the industrial power price, and I really don't like that. Thank you. I think you're not really, my opinion. Oh, yes, you are. Okay. I think you're already asleep. I shouldn't talk so fast. So industrial power, price for industrial power. Why is that so? Because if what the Federal Minister of Economy is telling us would be right, that this is just a bridging subsidy to bring down the prices so that after 5 or 6 years, with the then very cheap renewables, we would have lower power prices, then the companies would not need this price, because companies do not invest only for 2 years or to 5 years. A 5-year plan is a government thing, not for the private industry. No. Private companies have a longer time horizon for their investments, and the power price will not go down. That's the point. And this is why an industrial price will not help us, and it will not remain temporary. It will become permanent, and that actually counteracts the climate policy that we need for a reasonable climate policy. We have to bring up the prices for CO2 emissions, so energy has to become more expensive. And to subsidize that for the industry with a lower price is exactly the opposite of what we have to do. What we take care is that more CO2 is emitted in the end. What did the Minister of the Economy say last night? That we now have to have more coal-fired power for the winter because we don't have nuclear power stations anymore. Okay, so this is not a reasonable policy. That's not possible. And I don't even look at the financial burdens. I very much hope that in this coalition we will manage not to realize the price of power for the industry, which is special, or we'll have a situation in which this is made in a way that no one will use it. But that people really don't trust politics anymore is a matter of this. I wouldn't go on like this. I would have a more clear policy, actually, be more consistent, even in the long run, also for the energy. So one should really ask, how much gas will we need in the future? Where do we get that gas from? And how many emissions can we regulate by that? And we can only do that by giving a price to CO2 emissions, of course. And that brings me to the economic policy. I just said it, high inflation and very restrictive monetary policy, higher interest rates, and decrease of the balance sheet of the central bank. And we have to do that until we have inflation under control. And often I hear in discussions we have high interest rates. I mean, you are more a younger audience here. I don't see that often, but I see some of you who still know the 80s, right? I don't know if you remember. I like to say that in particular if Mr. Leber is present here, of course, we started at a higher interest level at that time, but at that time, the basic interest rate in the United States were more than 20%, and we don't expect that now, of course, I have to say that. But it would be very important to be very, very clear in the monetary policy with higher interest rates so that we will not have to have higher interest rates in the end, and that's the main message. In the end, that means for financial policy that they cannot be only demand-driven, but they must be supply-driven. And on the expense side, this means to get away from the very much consumer and transfer-oriented expenditure policy, more into investment policy. That is an important point. That when we reduce the government debts in time, we take some consolidation steps, of course, but that doesn't need necessarily necessarily that we will have massive savings in the end. Nominally, yes, but really not that's strong, and it would be in the minus because the expenditure and the income is going up. So even if we look at it from a real point of view, it's not leading to a lot of decrease. So when you actually want to go to other projects which have now higher priority, you have to save somewhere else. You cannot do everything. And anything after 10 years of economic upswing under Angela Merkel, with great growth rates, with a lot of income, where we didn't have to save anything, only in 2010, of course, but in the years after that, we saw an increase of government expenditure in everything apart from interest rates, in transfers as well as in consumption, as well as in government investments. We saw an increase every year. And then 3 years of COVID, always with the exception of the debt limit, so we were not bound to that limit. And that means that we were more relaxed about finances. 13 years where we didn't have to save much money. And if someone tells me now that there is no possibility to save any money in each of the sectors, I would just send them back to do their homework. Look at the books. And this is what we need on the expenditure side. On the income side, a policy which is supply-based means no tax increases. Regarding the companies, if we look at the basics for the calculation of tax, there can be some relief, and there we have to do something. I don't want to talk about individual measures like money for children, but 12 billion, that's possible. Okay, I talked about the energy policy. I leave the extension of the terms for nuclear power plants as long as it's possible to operate them. Hope will not die. The lack of energy in this winter could actually be avoided by substituting power generation with coal-fired power generation. And if we had just left the nuclear power stations on, this wouldn't have been so strong. And we also had some savings by increasing the energy efficiency among the population. We've seen that. That will probably help us through the next winter. This is a risk for the economic development, actually, that we will actually might run into energy shortages. We don't want that, of course, but we'll see if we manage over the summer. And savings help us, of course, but in the midterm, with regard to savings, we will not reach much with them. So we have to come up with an overall concept for the energy sector. We have to see what do we want, what capacities do we need in reserve if we want to generate power mainly by renewables. How can we make the approval procedures easier and so that it doesn't take 8 years to build up a new wind park instead of, but only 3 years. And then in the next 6 years, we will not be able to transform the power generation wholly to renewables. There's a problem with the grid. And how about the burden to the grid if we have to look at the money you have to pay to use the grid? And these are all systems that would need to be problems that need to be solved in a consistent system. And I don't see that anywhere in the federal government that anyone is working to get such a consistent system. It's all just a punctual thing, and there's certain ideas which how to achieve climate neutrality, but you cannot realize it against the market because we would bring the companies out of our country then.
And then we'll get to the further measures that are required, and that also should be possible in this period of the government. So trade treaties, migration policy, tax politics, deregulation. But I'm going to take a step back. So what do we have? So we're going to go into the medium term. I always demand a medium term concept for energy politics. We need to make advances in terms of climate change, and that past. If we want to reach climate neutrality due to the rules that we set for ourselves, but also in order to save CO2 emissions, we need to make advances. So the first challenge is the transition to climate neutrality, or the climate change as a problem. The second challenge that we have is here only very small, is the topic of digitalization. Maybe 2 notes on that. The third thing is the demographic transition. So for all 3 topics, we have discussed a lot, and we have solution proposals for that. The last topic I'm going to talk about soon, this difficult one. So the first one, climate protection. I'm going to say it again. Climate protection only works if we reduce CO2 emissions and if we price them correctly. So if we internalize the external effect, and for that the prices need to increase stronger. And in the EU, fortunately, we also have an agreement that the sectors not yet included should be subject to a new mechanism. And here we're going to start with 47 euros per ton. This is way too low. That means we will see increases in the upcoming years, and Germany needs to see that in the current system that we also get to higher prices. This is what will also drive energy prices in the future. That means in terms of competitivity, that which is called CBAM as an abbreviation, so the border adjustment mechanism that we use for CO2 emissions. This sounds good, but actually we need in the end to have international binding treaties. So the strongest emittants is China right now. The second one are the US. And then we have India, and then the EU. Germany has 2% of the entire CO2 emission. This is not a distribution problem. If we look at the headcount, we are way more ahead, of course, because we are a further developed society. But so the climate is not interested in distribution. The climate is not interested in how we distribute emissions. No, we need absolute reductions. And so the absolute stronger emittance needs to get down. And this is possible via a climate club, but we need to fill that in. The Inflation Reduction Act is doing that, what we're just talking about, but it has a Buy American clause, so we have high subsidies there. And I don't understand why Germans always are complaining about why the Americans are subsidizing in the climate domain. We have been doing that forever. So when did the EEG, the Renewable Energies Act come up? It's been a long time. And Ms. Merkel pushed this forward in 2011, and we really pushed in lots of subventions and not via the Renewable Energy Act was nothing else. The customers paid directly via their energy bill, and this went to the producers of renewable energies, and those really profited from that. That is okay if they profit. So we can't say that we haven't done anything and the Americans do, and we should. No, actually it's the Americans who follow suit right now. So this is not a pricing for CO2, that's true, but the CO2 pricing is done in the US on the US federal state level. And so the center for that can be found in California, and we have a couple of additional elements that we just discuss here in Europe and in Germany. And we have treaties between California and the Canadian province Ottawa to coordinate the emission trade systems of those 2 regions. The federal state is not even responsible for that, and Obama wanted to, with the Clean Air Act, he wanted to take up responsibility, and this did not work because they knew that the Supreme Court would stop that. This is a state thing, and so that's why we on a European level, we need to get into contact with the US federal states if we want to get ahead here. Everything else beyond pricing of CO2 and international treaties is peanuts. So we need the social compensation is necessary, but this only means that that money is paid back to those people who are hit the most. And this can only be on an individual scale, and with that I get to digitalization. We can't do that in Germany. It's impossible to do that in the short term. So when it comes to forecasts, if you can avoid, you should not name the figure together with a point in time. So official forecasts can't do that. Unfortunately, well, I would have recommended the finance minister to not mention the period in which he wants to reach his targets. He says 2 or 3 years, but I can't promise anything for which the German Länder are responsible. Germany is administered by the federal states and not by the federal government. And actually that works pretty well compared to other federal authorities. The administration is done by municipalities and the Länder. Also the financial one. And in Germany, we have over a decade of discussion. We managed in 2009 to have a coordination in the digital domain, so that Elster arrived as for fiscal administration. But Elster, here the federal government is part, and 15 Länder. One land does not participate. Which one does not? It's North Rhine-Westphalia. So this has been the easiest step of coordination. So what kind of climate money we need? This is something different. We need a link of tax ID and IBAN, and even without this link, without this add-on, I need to look at the time. And without this add-on, digital systems that we currently use in tax administration are close to breakdown. And if we put that on top, I don't see that working. So climate money is possible. We should implement it in due time, but that it happens in due time, I don't see that. And so this is only possible on a per capita scale. So carbon contracts for difference are difficult. There are better alternatives in order to help the majorly hit regions. There are better opportunities that are cheaper. Then I already talked about digitalization. I don't need to talk much about that. What is difficult here is the public sector, and also the data protection level is an obstacle here. That data protection is worth more than a human life. We saw that in Corona. We should revise that. So when it comes to demography, I'm going to leave you that table here. So the solution are absolutely clear. So you can talk about reduced work times and later retirement and such, all that you can do. But with that we have a reduction in wealth. If we have less work, then the growth will not go beyond 0.5 0.9% that we see in the forecasts, not in terms of economy, but in the long-term trend. And we will get back to that. And we have that effect from 2025 on. So if you want to get beyond 1%, people need to work longer. That means we need to have people work longer hours. We need to reduce part-time work, and we need to use the potential of the older people in order to get there. In order to finance social insurance, there's only a later retirement will help. Everything else might do a little, but this will not have a great effect. But from 2030 on, if we really want to offset this, we will really need to push back the age for retirement. So two more minutes. I talked about the last problem. It's not easy to solve. So I just described 3 solutions that we need to face in the near future. And one thing that we face is also the challenges in with other countries. We have a conflict with China, not with US, with China, not US with China, but we can't allow a state that has never been expansionistic in the past that they are right now. They are really expanding right now in Southeast Asia. That we need to fear this, and neither the US nor we, as their allies, can take this. Also from our own for our own interest. And also, we need to take care, or we want to take care of the fact that we can continue making good business with China. And the only thing that I can do as an economist is that I can create a dedicated policy of deterrence. Because what China does is something that we don't need. What we see here are dependencies. More than 40% of those wares and services that we receive from abroad and from only one state, from producers from one state, more than 45% we receive from China. And we like to talk about diversification, but this is not easy. So if more than 45% of rare earths come from China, then diversification is, well, a difficult thing. But we need to reduce that. And nevertheless, we need to keep up good business. So when it comes to diversification, again, here we can't think we all get this back to Europe, but we need to have treaties with other areas in the world, especially in the Mercosur area. These are the green areas here on this map, but especially with the US also. This is the alliance that we need. Also in terms of trade treaties, when it comes to TTIP or a follow-up agreement, the agreements that the Americans, they don't want that. But for individual domains of trade, we will have agreements, and we should also do that. Okay, last slide. I saw that. Thank you very much. Thank you very much.
Sie waren so still unterwegs.
So you were very silent, and as you were very silent, I just continued talking. And so actually, I always think you don't want any questions, but please, the first question in order to really challenge him. So we have 2 microphones here, and I learned that from my colleague Hans-Werner Zinn. You always need to fill out the time completely so that you don't have questions. But no, we were reducing the break. Isn't there a big danger by a European price on CO2 that CO2 intense productions are transferred to those regions where there's no price, where they will be producing even more CO2 in the end? So in this case, it would be, in the case of China, it would be fatal that by pricing of CO2, then if a transfer to China would occur, yes, you're right. You need to take care of the carbon leakage program, and that's why you need international treaties. And we really need binding treaties. Climate clubs allow it that we can do that step by step. So we do not need a multilateral big thing like in Paris. No, this has become more a development political thing, and reductions are no longer really the topic, but only what do the rich ones pay to the poor ones. But climate club means we begin, we take it step by step, and the most important partner here is the US. And then in the next steps we could make the decisive step with adding China, because if these three big groups will join a climate club, all the others will want to join too. So nevertheless, we need to say that the regions of the Earth have different possibilities to save up on CO2. There, where there's more wind and more sun, we can use more renewables. But there are many others. So in the past, we have made optimizations, and we managed to be upfront in products that have a higher added value, even though we have higher energy costs.
Herr Professor Feld, ja, jetzt bin ich da. Mir fallen viele Fragen ein.
So I have many questions, but I'm going to voice 2 or 3. No, you're going to take the most difficult one, and he needs to reply. So when it comes to fiscal policy, you said it should be less consumptive and more investive, what usually has more social expenditure. And then is this a forecast what you're doing, or is that a wish, or is that what you think is right? So if you say that the ECB should raise interest rates, is that a forecast or a wish or whatever? So and then we add what kind of figure should be before the point. I didn't like that last question. Everyone always says interest rates should be raised. But first of all, this is a forecast in part, and it is a normative statement. So on the one hand, the forecast that you saw in the numbers, that I think that interest rates are going up, and the reduction of the balances is of course useful. And when I got to the economic part, I said these are recommendations. This is a normative part. So I said clearly ECB needs to become restrictive. It has become more restrictive, but it has not yet become restrictive. The real interest rate is still negative. So there is still some more to come. So the real interest rate needs to be positive.
Hätte ich jetzt gemacht wahrscheinlich?
Das würde ich Ihnen gar nicht unterstellen. Das machen Sie bestimmt nicht.
Ja? Okay. Wo müssen wir denn hin? 6?
So where do we need to go? 6%?
Wenn Sie jetzt rechnen, haben Sie den Zins minus das.
So if you're calculating now, you have the interest rates minus the inflation rate, then you're at a negative rate. But the question is where is the point where you have the middle here? But I don't have an answer to that. And then we're back at fiscal politics. I've got the forecast on the one hand, and the next step, I said that normatively this can't be expensive and demand-oriented. It needs to become more and more restrictive, and you saw that in my figures, and we should continue that way. That means that when it comes to social expenditure, expenditure, there is no way around that. But this is not only domain-oriented. Please, these transfers are paid also with the family ministry, for example, and this for the last 13 years, this has been expanded a lot. And here, we need to ask ourselves whether a base payment for children is really something that works. And when it comes to transfers, we're already at subsidies. So are there other things? There will be another one, would be go further. So where's the microphone right now? So, but you also had a question. So we'll give it back.
Bitte.
Ich will es jetzt nicht überstrapazieren, aber kurze Frage.
A short question only. You don't see a danger that the bank failures from the US come over to Germany? Axel Weber yesterday said the contrary, and I always have doubts with banks that take care of people who invest 2 or 3 million. I didn't listen to Axel Weber yesterday, but what I read in the press release yesterday is that the problem, like we had at Credit Suisse, that this is not excluded in Germany. If you look at what we have at SVB, First Republic, and others, and at the medium-sized regional banks in the US, then the chance for the big banks in the US is strongly to buy them, to invest in them, and to get better business. So I don't see that, according to the figures that we have, at a bank of SVB or First Republic, that I see this spilling over to the world market. And I don't see that in the data because the products that would be required to have such a link, I can't see them there. And that's why I just said the American regulator sees the problem with its medium-sized banks, and the base problem exists for each of those medium-sized banks, and that this also happens for big banks or on an international scale. That's what they don't see and what we don't see either. At Credit Suisse, of course, we already shortened the break. Credit Suisse, so here there was not only the problem that Credit Suisse with their business and with their possible legal impacts, that this would have a negative impact. There was always the question, what skeletons do they have in the closet? And this is still unclear. This is still not entirely clear how Credit Suisse will, what kind of situation they will be in. In the end, we do not know that for the European banking system at the end. So we have 3 more questions. We have one here, one there, and one over there. And so Stefan, you already have it. So one question. Short questions, short answers, or else we're too much shortening the break. Stefan. So I have one question of understanding. Professor Feld, do you think it's good that the Bundeswehr, the army, the German army, does not order things, and that the money is not used, so that also the money and that the money for the climate transition is not used because the deficit remains low, or would it be low that we would do that quicker, but that would mean that the state deficit would rise? Well, I was not normative here, even though it might have sounded that way. If it did, then this was related to the inefficiency of the of this authority, not on this, the deficit situation. No, I wasn't very clear there. I need to say one more sentence here. This is a forecast. What is going to happen here? It's going to take a while until we bring the money to the road, so to say. So that we have a lower deficit afterwards. This is a side effect, but we need to say that if we would spend the money right now, then in the federal budget we would have to say that we we need to save in other domains. But this slowness, this is a German problem. So if you talk with Mr. Lindner, does he hope that things will go faster or not? This is like with me and nuclear power. Well, there's always hope. So one more question concerning the central banks. So I do hope, but I also fear that the central banks will try and avoid the hard landing and then reduce interest rates, and that we will, I don't know, slither away around. And what do you think? Well, this scenario is pretty probably actually, and it's one thing I fear too. That's why I talked about those 20.8% of Volcker, because that was exactly what we had in the 70s in the US, in France, and in Italy, and that the monetary policy did not cater for it, that we had positive real interest rates. And so in the end, this led to the fact that a more restrictive monetary policy was required, that led to many problems. Debt crisis, we already had we had debt crisis in the 80s due to these politics. So there is a lot of things attached to that. So this is one of the things that I fear. So you're right. And if we look at it in the US for this year, they forecast a recession, but we don't see it in the figures. And if you, so I don't really see the big hard landing. And also in Europe, I don't see it. We have a reduction in growth. So we're rather stagnating right now, but this is not a sharp recession where you would say the central banks would have done too much. No, I don't see that. So currently, it is more probable that the ECB will stay at the current line, that they will increase the interest rates twice again, and then that they expect, then that they estimate the impacts, and then we will see. Last question, and then we're going into the break. So Mr. Leber just talked about it, that there is a high demand in infrastructure in order to have this transition take place. And if we raise interest rates as you demand, then this will take place slower, and this will make power even more expensive. That's why I will have to have a higher feed-in remuneration for providers of renewable energies. So this will again make prices higher in the end, which then again is a burden for the country. So I see a dilemma in that. Well, I wouldn't say it's a dilemma, because that when it comes to your first question, that CO2 pricing needs to go up, then and that we need international treaties here. This corresponds to the raise in prices of power. So this is one reason for the fact why we see that when we say the power prices will not go down, and that we only need power for the next 4 to 5 years in industry. This is just untrue.